Hi guys, welcome to my videos. So guys, today in this video we are going to discuss a very important real estate term, what is negative amortization. So make sure you watch this video till the end, and just want to clarify, neither I'm a realtor or nor am anyone who has any professional relation with the real estate industry. So if you take anything out of this video, you do it at your own risk. So guys, real estate in Canada, we know that it's in news for various reasons. The most important, expensive, right? And of course because of the interest rates. So what is negative amortization? So guys, if you're familiar, when you take a mortgage, okay, you sign terms condition. So you sign initially for a particular amortization period, like for example 30 years. That means if you make regular payment at that conditions, at that payment plan, you would pay off your mortgage in 30 years. Now a mortgage payment consists of two components, principal and interest, right? So principal goes to the amount you owe and interest goes to the lenders benefit, you can say, because they are charging you interest for the money that they have given to you. Okay, now this negative amortization happens when you are on fixed payment and on variable rate of interest. When you are on fixed rate of interest for the term, let's say if you have taken for 5 years, regardless of what authorities, for example in Canada, Bank of Canada sets the interest rate, your payment is not gonna be increased or decreased. So that means whatever you are paying, you have to keep on paying. Of course at the end of your term, things are going to be re-evaluated and it will be taken over from there. That's fine. But with variable and fixed payment, what happens is, like when interest rate increases, okay, that means the interest that you're going to be paying, the interest component of your fixed payment is going to increase as well. So the moment I mean the point where it reaches that your whole payment you are paying is going towards the interest and not to the principal, in that case your amortization becomes stagnant, stable. Okay, means like if it is 29 years now, it will gonna continue 29 years until there is a change, until you make the same payment, same interest rate, because now it's at the point where all the money you pay goes exactly toward interest and no principal. But if interest rate goes further, what happens is that the payment that you are paying does not even cover the full interest part. That means at every payment you owe certain amount of interest, okay, extra than what you have paid. For example, let's say you are paying $1,000 a month now, okay, out of this $200 for a principal, 800 for interest. Bank raised the interest rate. Next month it became 100, 900. Third month it became $1,000 interest. So now you are at your trigger point, entire $1,000 are going towards your interest, so your amortization is fixed, it's not increasing, not decreasing. But what if bank interest rates further, and now your interest payment should be $1,100, but because you are on fixed payment and you are paying only $1,000, so that means at every payment your principal is increasing by 100, because the remaining interest that you did not pay gets added towards your principal and you are going to pay interest on top of that also in your next payment. So that is where what happens is your amortization gets increased. 30 years, 31, 32, 33, and it will continue, okay, unless you take steps. And of course this I have discussed these points. Now what are the solutions? So there are certain solutions that you can opt for, and those are like options I have discussed. First is to make a lump sum payment. But this could be very difficult considering the current financial situation, where you make a like a lump sum payment that entirely goes towards your principal. Like you can read your mortgage terms, like lot of lenders do allow, like I have 5 years fixed from a major bank, so they do allow up to 15%. But based on your circumstances and based on what you are going through, you can always negotiate. If you have money that you want to pay towards your principal, so that your money that you owe towards your bank gets decreased straight away, you can always go for that. But again, That could be difficult. Second is to increase your payment. So for example, you are paying $1,000. Okay, increase it. Let's make it 1,500. So that means 1,100 goes towards your um, interest, 400 goes towards your principal. That means still with this higher payment, you are paying interest as well as some principal. So the principal is decreasing. So at this time, your amortization will start falling. So it will no longer be a negative amortization, because with the time it will decrease. Third is move to fixed rate, means change the type of your mortgage. But again, payment term and other things you need to consider, and how much amortization, how much principal, how much interest you will be paying. So this is what it is. So guys, based on this, what I would suggest, like if you want to take my suggestion, again I'm not a real estate professional, is always go for fixed, because you get fixed certainty, like you know a particular number, 1,500, 2,000, whatever it is, that you have to pay every month for next 5 years. And you also know that how much lump sum or how much prepayment you can do. Most of the banks I know allow 15%, but you can check your terms conditions. So what I would do, like I'll be making this $2,000 payment a month, and also whatever I save, whatever my other expenses allow me, certain amount I'll pay towards the prepayment as well, so that at the end of my term I would have a good situation where I have made all my payments, so that I have covered a significant principal, and also I have made a lot of lump sum money, so that has gone directly towards my principal. So almost, and so you don't pay any interest on that, because any prepayment you make goes towards your principal. It's kind of lump sum payment. So this is what it is, guys, and I hope you have liked this video. So please subscribe to the channel. Thank you.